$4.11. That's the number. When Target's Q2 2026 earnings hit the wire, that was the headline. Earnings per share flashing in bright green across every single trading terminal on Wall Street. I mean, we're talking about a staggering 100% EPS growth year over year. Think about that for a second. At first glance, this looks like an absolute masterclass in retail execution. It looks like Target has completely cracked the code and solved the sticky macroeconomic puzzle that's been dragging down the broader sector for months. But look, in the world of high-stakes capital allocation, you never, ever take that top-line gloss at face value. You just don't trust the headline. You have to stress test the steal.
Which brings us to the absolute most critical question of this entire earnings cycle. Is this massive beat a real, sustainable operational revival, or are we just looking at a one-time accounting illusion dressed up as a comeback? Welcome to Iron Financial. I'm your host and lead analyst, and my mission is to help you forge a stronger portfolio and cut through Wall Street's hype. We're going to approach this with a heavy dose of market skepticism today, representing you, the everyday retail investor who is sick and tired of the fluff. Make sure you hit that like button and subscribe to the channel right now because we are breaking down exactly what is happening beneath the surface of Target's balance sheet.
All right, let's officially launch the Target Q2 2026 Earnings Iron Financial Stress Test. We are going to put their operational and structural integrity right on the anvil today. We'll rip apart the GAAP versus core operating metrics, we'll dissect those gross margins, and we'll analyze their forward guidance. Because when you see a 100% EPS jump in a retail environment where the consumer is supposedly pulling back, you absolutely must look at the exact mechanics of how that cash was forged.
Moving right into Section 1, the billion-dollar windfall, exposing the tariff anomaly.
Because, honestly, if you read just a little bit past the bold print in the press release, you immediately hit a massive anomaly with this IEEPA tariff refund. Are Wall Street algorithms confusing a one-off balance sheet cash injection with recurring fundamental operational power? Let me aggressively strip away that distortion for you right now. That reported GAAP EPS of $4.11, it includes a massive, completely non-recurring benefit. If we extract that tariff refund, the underlying adjusted core EPS, the true operational foundation of the quarter, is actually $2.46. Now, don't get me wrong here, $2.46 is still an increase of roughly 20% year over year when you exclude the tariff noise. That shows real, tangible operational improvement, mostly driven by supply chain efficiencies and lower freight costs. But come on, a 20% gain is a far cry from the 100% growth narrative the algorithms were buying into at the opening bell.
Let's put these exact numbers under the microscope, because the sheer scale of this refund is frankly staggering. We are looking at a pre-tax gain of $994 million, which dropped $752 million straight to the net earnings line. That is a $1.65 per share impact. You have to concede here, this billion-dollar windfall is a total one-off balance sheet event. Target successfully clawed back money from the government over the International Emergency Economic Powers Act. Awesome for the cash pile. Who doesn't love an extra $1 billion? But it is absolutely not a recurring gear in their operational engine. It artificially inflated their gross margin rate by 3.7 percentage points for the quarter. In the retail world, a 3.7% margin bump is gigantic, and it skews the entire picture if you aren't paying attention. So, let's look at the real business. Section 2, the core engine, taking a look at foot traffic and margin mechanics. The tariff refund is a cash injection. It's not the structural engine. I want to test the structural integrity of Target's true sales momentum, completely isolated from that $994 million tariff noise. We need to see if the consumer's actually walking through the physical doors and actually hitting the checkout button on the app. And you know what? The core engine is indeed firing. We have a solid 3.8% comparable sales growth figure. But what's really doing the heavy lifting here? It's the 3.6% overall foot traffic increase. In this economy, getting people to actually drive to your store is incredibly hard, but people are coming back to Target. Plus, we're seeing an impressive 8.7% digital comparable sales growth. Total net sales hit $26.5 billion, which is a 5.3% increase over last year. That is solid, undeniable top-line structural growth.
It's top-line growth, sure, but as a skeptic, I'm always looking for the cracks in the armor. Let's break down exactly what those people are buying, because traffic doesn't mean a thing if the basket mix destroys your profit margins. Looking at the category performance, we see double-digit growth in what they call Fun 101 and high single-digit growth in non-discretionary staples like food, beverage, and beauty. But the high-margin discretionary goods, apparel, and home furnishings, they remain stubbornly flat, sitting at roughly $4 billion and $3.6 billion respectively. The consumer is coming in for groceries and basic essentials, but they are walking right past the furniture and the clothing racks.
Which leads me directly to this massive strategic trade-off. Target management proudly announced they slashed prices on over 10,000 frequently purchased items over the past year to drive that foot traffic. Now, you really have to question the gross margin compression risks here. Slashing prices on everyday essentials to get people in the door, that's a pure volume play. Is this really a sustainable way to forge cash flow in a sticky inflation macro environment, or are they just sacrificing long-term margin integrity to buy short-term traffic? You can only compress your margins for so long before the core business starts to bleed out.
It's a calculated stress test on their margins, for sure, but you simply cannot ignore the sheer brilliance of their logistical blueprint. Target's omni-channel infrastructure is paying off massively right now. Look at this metric. They are fulfilling 97.6% of their total volume, and yes, that includes digital orders, directly from their physical stores. Same-day delivery grew over 25% this quarter alone. By using their existing stores as highly efficient fulfillment hubs, they avoid the crippling last-mile warehouse costs that absolutely plague their competitors. This logistics engine provides immense structural support to their operating margins. It's essentially absorbing the impact of those targeted price cuts while fortifying their operational moat against retail headwinds.
Let's move on to Section 3, the blueprint. We're talking guidance, capital, and cash allocation. We need to evaluate Target's future durability and see how management is steering the ship through these choppy waters. This is where the veteran trader in me gets incredibly focused. Target actually raised their full-year guidance. Now, their official reported guidance is $9.90 to $10.90, but remember, that includes our $1.65 tariff anomaly. If we strip that out, their new base operational EPS guidance is $8.25 to $9.25. Compare that to their old guidance of $7.50 to $8.50, that is a solid 75-cent base hike right to the core of their expectations. This shows genuine, steel-plated management confidence that they can forge a full-year net sales growth of around 5%.
And if you want hard, undeniable proof of solid capital allocation and overall business quality, look no further than their return on invested capital. A 15.4% trailing 12-month after-tax ROIC. That is up from 14.3% last year. Even when you account for the temporary tariff bump, generating mid-teens ROIC in a highly competitive heavy asset retail environment is incredibly hard to do. It proves that when Target deploys capital into store remodels and their digital supply chain, it yields heavy returns. This is exactly how you build a resilient business model that can weather macroeconomic storms.
But let's put on our auditor hats for a second, because I see a few potential red flags in this balance sheet health check. First, they deployed $1.4 billion in CapEx, mostly on store remodels. Fine, making the stores look nice is part of the brand, we get it. But let's talk about the inventory load, $13.2 billion. That is up nearly $1 billion from the start of the year. Target got burned so badly on inventory bloat just a couple of years ago. Why is it swelling again? Are they overestimating demand? And more importantly, they have $8.3 billion in remaining share buyback authorization, yet they didn't repurchase a single share of stock in Q2. Not one. If the foundation is so solid and the core engine is humming like they say, why isn't management buying back their own stock at these levels?
Well, the likely answer is they're preserving liquidity for cyclical flexibility. And the truth is they are still returning massive amounts of capital to shareholders, just in a different format. They just hiked the quarterly dividend by 1.8% to $1.16 per share. That translates to an annualized yield of roughly 3.0% at current valuations. For dividend growth investors looking for a reliable cash flow pillar in their portfolio, Target has proven they will defend and grow that payout. They distributed over $500 million in dividends just this quarter alone. In a shaky macro environment where growth is uncertain, steady cash in your pocket is worth its weight in iron.
All right, it's time for Section 4, the clash. Bullish iron versus bearish rust.
We need to synthesize these opposing forces into a clear market reality. Let me fire off the bear case first. The rust is creeping in. The bear argument is that Target is mutating into a lower-margin grocery player. They simply cannot outscale Walmart on essentials, and they are heavily relying on 10,000-plus price cuts in a sticky inflation macro environment just to get traffic, all while their high-margin discretionary goods remain totally sluggish. But here is the bullish iron counterargument. The bears are looking at the lag, not the leading indicator. The omnichannel infrastructure is proving its immense leverage right now. The traffic is back, up 3.6%. They're surviving the macro downturn by selling essentials efficiently, and when consumer discretionary spending eventually rebounds, the structural setup means their margins will see explosive, unmatched operating leverage because their physical footprint is already fully capitalized to handle massive fulfillment volume without additional last-mile spend.
Which brings us to Section 5, the final verdict. Is Target an iron opportunity or a value trap?
We have heated the metal, we have struck the anvil, and now it is time to deliver the bottom line for portfolio builders looking to cut through the Wall Street noise. Because here is the ultimate hesitation of the retail investor right now. The broader Wall Street analyst consensus currently has a hold rating on Target with a price target around $143. They are sitting entirely on the fence. Well, we don't sit on the fence at Iron Financial. We demand a clear answer. So, is Target a solid foundation for your portfolio, or are you buying into a tariff-fueled accounting illusion?
Here is the final decisive verdict. Once you strip away that billion-dollar tariff illusion, what you have left is a highly robust omnichannel infrastructure that is successfully grinding out market share in a really tough environment. Target is not a value trap. It is a coiled spring. For dividend growth investors, that 3% yield provides a solid steel beam for your portfolio while you wait for the cycle to turn. For value and swing traders, the actionable takeaway is that your downside is reasonably protected by their sticky grocery traffic, but the real explosive upside will trigger the exact moment the macro environment allows consumers to start buying higher-margin apparel and home goods again.
The core engine is built to last, but the timing of the breakout depends heavily on the consumer. That wraps up this explainer. So does Target have the structural integrity for your portfolio? I challenge you to share your own stress test verdicts down in the comments below. We want to hear your bull and bear cases. And as always, to keep forging a stronger portfolio and cutting through the market weakness, remind yourself to subscribe to Iron Financial. We will see you in the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.